Good afternoon. Welcome back, everybody, to Lunch and Learn. Hi, I'm David Cowan, president of the museum, and joining us today is Joel Tillinghast, and he manages several funds at Fidelity, including the Low-Priced Stock Fund since 1989. Prior to assuming that role, he worked as an analyst at Fidelity. He held several other positions before that, including Director of Research and Strategy at Bank of America Futures, and as a research economist at Drexel Burnham Lambert. I was just showing Joel, we happen to have a whole collection in the archives of Drexel Burnham Lambert material, and I'll show you just one. There you go. Now, in the introduction to this book, written by Peter Lynch, obviously a legendary stock picker, he is effusive in his praise for Joel, calling him one of the greatest stock pickers of all time. He then follows with, if you were to look up alpha, the word alpha in the dictionary, he would argue you'd see a picture of Joel there. And so with that in mind, we were really looking forward to hearing some alpha from Joel today, but I want you to know that the book will be on sale afterwards. Joel will be happy to autograph it with you. And I know that there is a close to a month delay at Amazon, so it would behoove you to buy it here today rather than have to wait. It's my pleasure to introduce Joel Tillinghast.
So the book is Big Money, Think Small. And why did I write it? It's because I've made lots of blunders and mistakes in my portfolio and have lots of friends and family who have torpedoed their portfolio. And my conclusion from that is it's, a lot of investment books promise everyone can make $1 million. In fact, I read that very book by Morton Schulman long ago. And I don't think any book can turn you into Warren Buffett or even Peter Lynch. Not even Peter Lynch's books, which are fantastic books. And I do think, however, that it's possible to stop doing dumb things. And that is in the power of every person who puts in the effort. And the aim of this book is to make you a better investor by not doing dumb things. So there are 5 big buckets of wrong things. You can either approach them as this is what you want to do, or this is what you don't want to do. As Charlie Munger says, invert, always invert. And I'm suggesting, think about what you really don't want to happen to your portfolio and don't do it. So those 5 big buckets. What you want are right attitude, the right knowledge, the right people, the right business, and the right price. And so what do I mean by right attitude? What you want is to be a long-term, rational investor. What you don't want to be is a short-term, irrational gambler. For the second point, limits of knowledge. Know what you own, Peter Lynch famously said. The opposite of that is not understanding where a company will be in 5 years. If you can't have a bit of a forecast that has some validity 5 years out, you really shouldn't invest in it. Third, what you want are honest, capable stewards of your capital. You want to have, if you're investing in a fund, you want managers who are capable stewards and honest stewards. If you're investing directly in stocks, you want corporate management who are honest and capable stewards. What you don't want are crooks and idiots. And the capable, what do I mean by capable? I see 2 parts to the definition. One part of it is steering the company or portfolio on a distinctive mission, something that other people aren't doing. If you're producing a commodity, you might as well index. And there's nothing wrong with indexing. In fact, for a lot of people who aren't that interested in investing, I think it's a perfect solution. But if you're picking an individual business, you want companies that are doing something that is unique and valuable to the customers. The second part to being a good manager, or a capable manager, is do they use capital well? Do they spend capital on projects that will produce a high rate of return? That's more technical. But the honesty problem, or you want honest people. How do you tell an honest manager? The problem is telling the crooks is for gentlemen of a certain age, like the PSA prostate test. And what I mean by that is if there's 1 in 200 of a population that are crooks, and there's a 5% error term, it means there are going to be 10 people out there who are freaked out because they have been tagged as at risk for every one that is actually a crook. And the problem with most of the tests for crooks is that they're very noisy. But I think you can actually filter out the crooks. How aggressive accounting is, for me, the primary way to tell the crooks, but also promotional managements who overpromise and don't deliver. There are havens for crooks. Florida. And why do crooks like Florida? Because you have affluent, older people who sensibly want to kick back rather than do the due diligence, and they take advantage of that. And in the not too distant future, that seems like a sensible solution to me, but not yet. So there are signs that help you stay away from the crooks. Fourth, what you want are resilient, durable businesses. What you don't want are faddish businesses that are going to be blown away, and the businesses that are going to endure are doing something distinctive, something that others can't do in an area that doesn't change very quickly and where you can see the vectors of change. Frustratingly for me, this isn't a once and for always sort of thing, because I felt like I understood retail very well until Amazon, where suddenly maybe it isn't in my circle of competence. Maybe it's not a business where I understand will, a friend said, having diapers delivered to my home for less than I pay at CVS, that's marvelous, and I can see that. So maybe everyone will say they're bulky, they're a pain to lug home from the drugstore, and I can get it cheaper. But I can't predict quite how that will go. Or foods. People's dietary preferences change slowly, but people have gone from being, Coca-Cola, what could be nicer? A little bubble, a little caffeine, a little sugar, to, oh, that's an empty calorie and sort of dirty and, yeah. Or like the Jim Grant, Sin, they had a picture of a busty woman in Sin circa 1960. Sin 2017 had Coca-Cola. But dietary preferences change slowly. But handicapping the change in technology, that's impossible for me. So my conclusion is it takes a different sort of mind than I have to really do well with technology stocks. There's a chapter called Tech Stocks and Science Fiction. My argument there is that to do well, you need to have the mind of a science fiction writer and imagine what's possible and imagine the downsides also of technologies. Before technology ruled the financial world, they had more of the apocalyptic science fiction, which I kind of like for whatever reason. But now the audience for science fiction has changed because maybe they are making too much money to examine the downsides of technology. But it's hard for me to predict, and I think it takes a different sort of imagination. What makes a company not resilient financially? It's too much debt, and that gets very technical, but there's a chapter that talks about what is too much debt, and it's basically a mismatch of when the cash flows will come in with the form of financing. And the final thought is don't pay too much, buy undervalued stocks. And so those are the 5 buckets of mistakes.